Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar on correlations and technical analysis of commodities, indices, and FX. We're very pleased to have with us today Darren Chu, who is a CFA and founder of Tradable Patterns. So without any further ado, let me go ahead and make you the presenter. I'm going to pass you the controls, Darren. If you could share your desktop, let's go ahead and get underway here this morning or this afternoon. Thanks so much for joining us, Darren.
Thanks for having me, Cynthia. How's everyone doing today? Hope everyone's well. Welcome to today's webinar on correlations and technical analysis of commodities, indices, and FX. My name is Darren Chu, and in the next hour, I'll be going through hopefully a fair amount of educational material around the relationships across different asset classes, and also within each asset class itself. You'll find that for quite a number of the markets that I'll be speaking about today, there are relationships which change over time, and it's oftentimes quite interesting to futures traders, especially those who are trading spreads, to monitor such correlations. In today's discussion, I won't actually be getting too deep into sort of the numerical aspect of these correlations. Rather, we'll be going into a graphical display of how these relationships evolve over time. So as with correlations among any pairs of markets, whether it's commodities, indices, or FX, generally what we'll find over time is these correlations do change. So let's just jump in here on this very first slide. I just have an additional set of disclosures. Let me just try to move my control panel here. Okay, so I'll just let you all kind of read that. But essentially, what this says is that nothing that I'll be sharing today is meant to be investment or trading advice. This is educational in nature, what I'm about to share, and please don't interpret any of past performance as being indicative of future results. Let me get to the next slide here. So just a little bit of background about myself. So I've actually been running Tradable Patterns. For those of you who've been to my website, tradablepatterns.com, you'll know that I have a daily newsletter. It's something I've been writing and publishing within Interactive Brokers' TWS and various other web pages of IB, as well as within Bloomberg Terminal and other institutional platforms like Refinitives, FactSets, and so forth. And my coverage extends across CME ICE, equity index, commodity futures primarily, with a fair amount of spot FX coverage, occasional VIX analysis, and I have once a week analysis on cryptocurrencies as well. So I do have a watch list, which perhaps I'll point out later, but it's basically a section within my website where you see the full list of markets which I have a rotational coverage across. So prior to kickstarting Tradable Patterns in 2014, I was working at ICE Intercontinental Exchange in Singapore, first joining NYSE Life, so that's the New York Stock Exchange, Life being the London International Financial Futures Exchange, where from 2010 to 2014 January, I was basically looking after our futures and options business development activities in Australia, India, and the UAE. And eventually when ICE took over in the early part of 2014, I began expanding that scope to much of APAC until shortly after leaving in April 2014 to launch Tradable Patterns. And prior to NYSE, I was actually at the TMX Group, that's the Toronto Montreal Exchange, based in Toronto, working for the Montreal side of that business, where I was basically promoting Canadian futures and options marketplaces across much of North America and London Singapore and Hong Kong as well. Prior to that, I was with CMC Markets Canada in Toronto, where I basically created a educational platform and really started training traders on technical analysis and spot FX and CFDs. And around the same time that I was with CMC and also with the Montreal Exchange, I co-authored 3 courses that are offered by the Canadian Securities Institute, courses on derivatives, which investment professionals in Canada need to complete in order for licensing. So in today's session, I'll first start by talking about the relationships among agris. So this is not an exhaustive list of agris. It's really just the agri markets which I currently cover through my newsletter, in which I trade quite regularly. And so I'll talk about some of the fundamental reasons why the correlations exist, why they change across those particular agris. And then we'll hop into our discussion with indices. I'll talk about how the NASDAQ 100 correlates with the S&P 500 and what that means for the VIX. And then we'll take a look at some relationships within the FX markets. So in that list of FX pairs, I'll look at certain US dollar centric pairs and how they relate to each other. And we'll also take a look at pairs where there may be impact coming in from specific commodities such as WTI crude, for instance. So some of you might be trading the US CAD, or perhaps you trade the Aussie US dollar. You'll know that WTI crude tends to have quite an impact on the US CAD, and the Aussie US dollar, although it does correlate with WTI crude at times, it doesn't correlate as strongly as with the US CAD. And in fact, the Aussie US dollar is linked more to other commodities, which I'll get into later in the presentation. And then we'll talk about safe haven markets. So obviously, with all the geopolitical risk that traders are currently or throughout history have been monitoring, many traders have discovered that certain FX markets have a safe haven role that they play, or have a way of attracting flows during such geopolitical flare-ups. Okay, so we'll talk about correlations between gold, the US dollar, Japanese yen, and the dollar Swiss franc, and why those correlations evolve. And then we'll talk about whether or not there's still an impact from the sterling, the British pound, on certain commodities, which would in times past, well, now we're talking probably 20 years past, were strongly linked to the British pound. Okay, so we're going to look at whether or not those previous relationships still hold, and then we'll talk about why that relationship has evolved. And then lastly, we'll just wrap things up by going through a recent week of technical analysis, just spanning September 30th to October 4th, going through the different asset classes which my newsletter would have provided analysis on. And so the whole objective of looking back a couple of weeks is really just to see what would have been predicted based on some of the technical indicators and patterns that would have appeared on these markets, which I've listed here at the time. And then we'll take a look at how those markets performed in the time after that initial analysis. So starting off with agris, we're going to look here in this chart. This is taken from stockcharts.com. Some of you may have already come to stockcharts.com at various points. It's a fabulous resource, really great for its functionality on charting, and much of it is free. So what I've done here is I've plotted wheat's continuous contract from the CME and that would be what you see depicted by the candlesticks. And what's on this same plot as the wheat price action would be the soybean price action as depicted by the black line. So the black squiggly line is your soybean, and you can see that with the two markets basically plotted on top of each other, you can see that the correlation just visually, just by looking at the way the black line tracks the candlesticks, you can see how closely they correlate. Now in the lower plot, just beneath the price plot, you see this correlation chart, and on that correlation chart, you can see that prior to early 2016, the correlation between these two markets was actually rather high, at roughly 0.5 to 0.8 throughout much of the 2010 to 2016 period. But what you'll see is that the correlation dropped quite dramatically, and it even went into the negative, perhaps unexpectedly for some. Just given the way that these two markets have correlated so strongly over time, one might have been surprised to see a negative correlation period. And this is a fairly lengthy period that you can see in 2017, or the better part of 2017, as well as the better part of the second half of 2018 through 2019, up to this was taken October 1st. So you'll probably be wondering why correlations where for much of a pair of markets is historical range, where those correlations have been previously strongly positive, in this case above 0.5, 0.6, how that can eventually flip to, well, I wouldn't say a complete inverse, but the fact that it fell to below zero was notable in itself. So one thing to keep in mind, obviously, is when looking at correlations between two markets, obviously you need to ask yourself, what is the economic reason behind why these markets, these pairs of markets are correlating in the first place? Is there causation going on? Is there spurious correlation going on? Well, in the case of wheat and soybeans, without even having to have an agricultural background, I think for most people it's probably intuitive that these two crops, these two agricultural markets, tend to move fairly in sync, quite often just due to the fact that a lot of farmers of wheat will often also contemplate growing soybeans, perhaps in the same plot of land, same acreage, if the price of soybean rises sufficiently above that of wheat, creating a great enough premium or incentive for the farmer to switch to growing soybeans. So there's you could call it a substitution effect, obviously on the demand side. So just now we're talking about supply from the farm production side, but from the demand pull side, you can imagine how these two crops are oftentimes sold to the same consumer groups. So when I say consumer, I'm not referring to individual consumers per se, but there are food processors as well as livestock producers who will purchase both wheat and soybean to use as feed, along with corn, and they'll use that feed to provide for their cattle or perhaps for their poultry or pigs. And so that's a reason why quite oftentimes these markets, these two in particular, will move quite in sync. And given that a lot of these markets that I'm going to be talking about today, not just wheat and soybean, but especially with wheat and soybean, you'll find that quite a few of these different varieties of agriculture products are grown in the same region. So they might not necessarily always be grown by the same farmer, obviously on the same plot of land, but for various crops, you'll find that they they tend to do well in the same, whether it's a temperate climatic zone or a tropical, perhaps an even drier, warm climate zone. And so for reasons of weather, climatic conditions affecting crops in a similar way, crops within the same geographic region, you will tend to get a similar kind of supply impact. So, if you just think about floods that were hitting many parts of the states earlier this, I guess it was around May or June of this year, we would have seen the price spike up on both soybean, wheat, and corn. So, anyways, let's move on to our next pairing here. This is actually the same pairing, but in this chart, what I'm trying to depict here is how wheat can be expressed in its price as a percentage of soybeans price. So if you look at the y-axis, just the price axis on the or not the price axis, but rather the numerical value on the y-axis to the right, what you see is the percentage that wheat is trading at of soybeans price. So quite often throughout the entire history that I guess wheat and soybean has been traded as futures contracts, we will be able to, just from this plot, which isn't the most exhaustive chart history, but from this chart alone, you can see that there is a range which wheat has traded as a percentage of soybeans over this 10-year period, which has been largely within this point. You can call it the 0.4 to 0.7 or 0.75 of the soybean price. And so in percentage terms, that would be 40% to 75%. Now on to the wheat-corn relationship. So wheat and corn are interesting to look at as well, obviously, for similar reasons that I just provided for the prior relationship. And the reason why we're talking about corn is corn obviously is produced in very large quantities out of the States, but from other countries as well. And what's important to always bear in mind, obviously, is who the major importing and exporting countries are for each commodity that we're looking at. And when looking at this particular relationship of wheat and corn, obviously, some of you have cars that are run on biodiesel. There's probably, and I'm not familiar with what the current biodiesel fuel component that's mandatory in the countries that you reside in are necessarily, but in some countries that mandated percentage might be 10%. So there's been a heavy production of corn, or heavy allocation of the corn production towards biodiesel uses. And so corn basically has been, for quite some time now, well over 10 years, probably close to 20 now, in many countries has been used for producing ethanol. Okay, now wheat is not used so much for biodiesel. It's really correlating with corn more for the feed demand side from the livestock producers, and it's not just for livestock. A lot of the aquaculture producers, all the fish farms and other seafood farmers, are increasingly using either wheat, corn, or soybeans, or maybe combination of these grains in feeding their shrimp or fish or whatever it is they're raising. Okay, now on this next chart, we're looking at the wheat as a percentage of corn relationship. And so unlike with soybeans, wheat is actually traded at a premium to corn. So soybeans, of course, as I mentioned before, trades higher than wheat traditionally. And so with this particular chart, and with spread trading type strategies, generally what traders will look for is where this relationship, not just with the wheat versus corn, but also with the wheat soybean that I had just mentioned. We generally look for opportunities to seize on when the price of one of these two markets, so in the case of wheat and corn, a trader might look for where wheat is unusually discounted to corn. So if you look at mid-2011, you can actually see that the candle, the white candle that protrudes to its lowest point in mid-2011 would have brought the percentage that wheat was trading of corn below 1. So that doesn't happen very often. And obviously that could have been a very profitable trade had one held. These are monthly candles, so had one held even 1 month later, you could see how that percentage spiked up. Okay, now talking about corn versus soybeans, you can see very similar plot of correlating lines, or correlating markets rather, where again corn and soybeans track each other quite closely. And in fact, unlike with the the wheat soybean correlation table that we were looking at earlier, the corn soybean correlation line, this black line on the lower plot, it never actually falls below 0. It gets to just above 0, but it doesn't go into the negative. Okay, so just keep in mind, you know, these relationships, they're never fixed, in that there is not a predefined maximum. I guess with any price, you know, of any financial asset, there's no ceiling to how high a price of a market can go, right? But obviously we know the lower bound is always 0. But when it comes to correlations, just to be clear for those who perhaps haven't noticed yet, the correlation table or graph plot has a defined range, right? You can't have correlation above 1. So when the correlation is 1, just to make sure we're all on the same page here, 1 as a correlation just means that the two markets within the pair are moving lockstep on a 1-to-1 ratio, okay? Whereas if the correlation was 0, that would just mean that one market could move up and the other market would not react. And if the correlation is -1, it just means that if one market moves up by X%, then the other market can be expected to move inversely by that same magnitude. Okay, so if we look here at this next plot, what we're looking at here is corn expressed as a percentage of soybean on the price. Okay, so corn is trading generally cheaper than wheat, which in turn is trading lower than soybeans. Okay, so we have again opportunities that could be more easily identified when plotting these charts, as I've done here. Okay, so now let's jump to indices. With indices, like the S&P 500 and NASDAQ, obviously the correlation's pretty high. We don't ever get negative correlation, or at least within this period of 10 years on this monthly chart, we didn't even get close to a 0 correlation. In fact, in 2016, you can see that the lowest the correlation ever fell was roughly 0.5, and it really stays above 0.7 for most of its history. Now, when you express the S&P 500 as a percentage of the NASDAQ 100, you can see that over the last 10 years, at least, we've had a downtrend, a down channel. Now, are there reasons that can explain this? Well, we only really need to think about the growth mode that tech stocks, generally speaking, very broadly speaking, have been in since the GFC, and tech stocks in general over time as a broad sector have for many years have exhibited stronger growth than the more mature blue chip stocks that tend to characterize the S&P 500. And so you can see how, particularly in a strong tech bull market, this downtrend on the price level of the S&P 500 as a percentage of Nasdaq it becomes quite pronounced. Okay, now sometimes when we try to trade the VIX, we do have, I mean, most of us have an intuition or perhaps an observation that the VIX inversely correlates to the S&P 500, suggesting that anytime the VIX spikes up, that the underlying instrument that the VIX is calculated based off, basically options on the S&P 500, are implying downside volatility. Now, when I say downside volatility, I'm referring to a spike up in volatility as a result of downside price action on the S&P 500. Okay, so just to be clear here, this relationship is not very constant, and you can see from the correlation table at the lower plot that although this inverse relationship has held for most of its history in this 10-year plot, we did have various times, especially in 2018, where this correlation became positive. Not hugely positive, but in the Q3, early Q4 of 2018, you can actually see the correlation rose to almost 0.5, which is pretty high, quite counterintuitive. So why does that happen? Well, first of all, there are many reasons that have been cited over the recent past on why some traders have been reluctant to fully embrace the VIX as a volatility product to trade. There are all kinds of, we really don't have too much time in today's session, but there are all kinds of reasons that are well disclosed, well documented by a lot of traders online. There's been a lot of media coverage on this, on why some traders have felt that the VIX has become somewhat of a broken barometer of risk or of volatility. And there are other, obviously, barometers for that, but the VIX really has a share of fans, but there are a lot of reasons why it perhaps has not behaved the way many traders who previously had a go with trading the VIX would have experienced on the relationship that they expected. Okay, so let's go into FX now. We're going to jump into first a couple of these US dollar centric pairs. So the US CAD and the dollar yen. You can see from the candlestick and the squiggly black line relationship that this correlation is pretty positive. But looking down at the table beneath the price plot on the correlation plot, you can see that yes, it actually does go into the negative as well at times. Okay, so this lower correlation plot is something I would recommend for you all. I mean, anybody who's looking to pairs trade to really pay attention to, because oftentimes just by eyeballing the way the two price lines, or in this case the black line of the dollar CAD and the candlestick price action of the dollar yen, I mean, it's basically not not reliable enough to just look at the way those two lines or those two price data patterns hug each other or stray from each other. Okay, the correlation table at the bottom will, at a glance, provide the message much clearer. Okay, and on the dollar CAD versus dollar Swiss franc chart here, you can see that that correlation between these two markets is similarly to what I just showed you. It's largely positive, but also in the 2014 period, or even late 2013 to late 2014 period, we had a negative correlation. Okay, now looking at the dollar yen and the dollar Swiss franc, I guess the story is similar. Again, around the same period actually as in the previous slide, we see a negative correlation in the late 2013 to late 2014 period. Okay, so I guess more interestingly for a lot of you might be trying to understand the relationship between the FX pairs where the US dollar is in the numerator. So for this particular illustration, we're using the dollar Japanese yen, where the US dollar is the numerator. And in our FX pair where the US dollar is the denominator currency, we have the euro US dollar. Okay, so quite oftentimes intuitively we would think that when the euro US dollar rises, the US dollar Japanese yen should fall. But this correlation plot down here, it shows you quite clearly how this correlation, it does actually go into the positive quite a few times within this 10-year history. Okay, so it's not as clear cut as perhaps some may have assumed. Okay, now on this next chart, what we're looking at is the dollar yen pound US dollar, and what we're looking at is again an illustration of how this correlation it really jumps around. So obviously, with what's happening with respect to Brexit and the way the market is sort of anticipating the October 31st date, the correlation will exhibit characteristics that are outside of the sort of the historical norm due to the Brexit situation. But even looking within this 10-year period, you would be able to say that there is no real historical norm in the sense that this correlation was not predominantly positive, or it was not historically in the negative for more than, say, half of its history. And so this is there's just an example of a pair of markets where you probably would have no interest in doing a pairs trade for. Okay, now in this next example, where you have two currencies that have the US dollar as their denominator, the euro US dollar and the pound US dollar, you do have a much higher correlation as expected, and it only hits below zero, only goes below zero briefly in Q3 2016. Okay, so that's I guess that's to be expected. After all, the Eurozone is the UK's largest trading partner, and they are both trading groups, or both economic blocks. You can say are impacted by similar external forces, particularly coming back, I guess, to the key point I made earlier. These two pairs both have the US dollar in the denominator. So whatever impacts the US dollar or the US economy through inflation data or jobs numbers will impact these two pairs in a similar way. Okay, so that's generally when you get the correlation becoming positive, or you could say overwhelmingly positive, is when the economic data that is impacting these pairs is specific to the US economy. Okay, now for the Aussie US dollar, Euro US dollar relationship. Here, as with the previous slide, we can see a predominantly positive correlation history. However, there is this period between mid-2013 and mid-2014 in the correlation. We have a negative correlation. So when we observe a negative correlation on these two particular FX markets, what generally I would first ask is, what were the economic or political events that impacted Australia and the Eurozone specifically during this period of mid-2013 to mid-2000 or Q3 2014, right? So once again, the point I made on the previous slide, that highly positive correlating regions within the correlation table would generally coincide with periods of economic data that impact the US economy and which drive both the Aussie US dollar and the Euro US dollar to behave in similar ways. Okay, so now we have the Aussie US dollar versus the pound US dollar, and you can see the correlation is a little less positive in the sense that there are more dips into the negative on the correlation between these two markets. And I guess it should be obvious. I mean, the UK does not have Australia as its largest trading partner. The two blocks are not next to each other geographically, and so they get impacted by different kinds of trade flows, natural trade flows. So that would explain why the correlation between these two markets is less than what we saw between the Euro US dollar and the pound US dollar. Okay, and now for the Aussie US versus Aussie yen. So quite oftentimes, I personally trade both of these when I feel that the Australia economic data, or perhaps Australian Reserve Bank, central bank known as RBA, is about to announce data or perhaps release comments, minutes that may impact both of these pairs in a very similar way. So when you look at the correlation plot at the bottom here, you can see that these two markets are quite positively correlated for the most part. But again, there are times when you get negative correlation, and that can be explained more by the fact that there are economic or political events that will impact Japan specifically and not impact the US economy necessarily, and vice versa. Sometimes there are US economic data that doesn't really have much bearing on the Japanese economy. But obviously, with Japan and the US being large trading partners, there is some impact as well. And of course, we do know that the yen does have a safe haven role that it plays or has played throughout much of history. And I'll have more comments on that on one of the next slides. Okay, so now here we have the Euro US dollar versus the Euro yen. And again, you can see that the correlation is largely positive, which again just refers to those periods where the Eurozone economic data is impacting both of these pairs in a very similar manner. But then, of course, you also have events of a perhaps geopolitical nature or just a political or economic nature that are specific to the US or to Japan. And those are those are events that will turn this correlation towards zero or into the negative. Okay, and now for the pound US versus the pound yen correlation. This is perhaps one of the common one of the more common FX pairs that that come onto my particular radar. I do like the volatility that come with both of these pairs. The pound US typically exhibits something like 100 to 150 pip range each day, and the pound yen, I've seen the pound yen move 500 pips in a day, and maybe even more than that. But yes, these two markets are not for the faint of heart, especially given the volatility that we've seen of late due to Brexit, which hasn't happened yet, but yeah, there really has been a nice little bounce on both of these markets. I'll get into the technical analysis a little later. Okay, so I think this is one of our last slides here on correlations. I'm just going to have to go through our material here a little faster. Please bear with me. The pound US, pound Aussie, I'd have to say can be tricky to trade just due to the fact that this correlation history, you can see, is all over the place. Okay, sometimes it's heavily into the positive region, very close to a +1, as we see in 2017. And at other times, it's been almost -0.75, as we see in 2015 and also earlier in 2011. Okay, so WTI crude has been studied extensively for its impact on food commodities. A lot of crops, a lot of things that grow on the ground. They need fertilizers, right? So fertilizers oftentimes are actually developed with byproducts of crude oil. Okay, there are some derivatives, not as in financial derivatives, but there are byproducts of crude oil that are used to make fertilizer. So if crude oil rises in price, fertilizer cost rises, and maybe the farmers pass on some of that cost onto the end consumer or to whoever's buying the crop from them. So on this slide, we're going to look at what WTI crude can do to other commodity markets, as well as to the dollar CAD. Okay, so on the dollar CAD futures specifically, which is really not the US CAD futures, but just the inverse of that. Okay, so when you look at these lines, but specifically the black line, which is the Canadian futures traded on the CME, and the WTI continuous contract on the CME, which is illustrated by the candlesticks, you can basically see that the correlation is quite positive for most of the history. And of course, looking down at the plot beneath on the lower plot, you can see for 2014, the correlation actually does dip quite into the negative to about -0.5. Okay, so now on this next slide, we're looking at how the WTI correlates to the dollar CAD. Okay, so the black line now is not the Canadian futures anymore on the CME. This is actually the spot FX pair of the US dollar Canadian. And so what we're seeing here should be the inverse of what we saw on the previous slide. Okay, so let me just flip back to this slide where the correlation is fairly positive, and onto this next slide where the correlation is largely negative. Okay, and onto this next slide, you can see basically from the upper plot, you can see that gold and WTI also seem to have a positive correlation at times. And when the correlation becomes highly positive, such as during the second half of 2010 through to the rather Q2 of 2011, you can basically see that the correlation is quite positive. And that could just have been due to the fact that the Eurozone was experiencing a crisis. There was the Euro crisis. And with the threat of the PIGS countries, Portugal, Italy, etc., coming out of the EU, with that possibility rocking the euro, but also just creating a flight to safe haven type activity, gold would have risen, and so what we are seeing here with WTI crude, well, I can't actually remember exactly what drove WTI crude within the 2010-2011 period to rise, but basically what we need to be aware of is sometimes there could be geopolitical events that actually cause the flight to gold for the safe haven status or role that it often plays, as well as into crude if there's a geopolitical flare-up in oil-producing regions such as the Middle East. So I can't specifically remember what was going on during 2010 and 11, but perhaps there was some kind of a flare-up in an oil-producing region of the Middle East. Okay, now for this next slide, where we illustrate the relationship between crude and corn. So I mentioned the fertilizer input coming from a derivative of crude oil, but I guess the other thing to keep in mind is when farmers in developed countries or even less developed countries produce crops or harvest crops, they rely very much on mechanized equipment. So that equipment needs to also run on fuel of some sort. So again, that's an input cost, which farmers will try to pass on in the form of higher prices on the crop that they're selling. Okay, but of course, WTI crude can be thought of another way as well in what impact it makes on food crops or food commodities generally speaking. Crude is a very large component of most inflation indices maintained by various countries around the world. And so when you look at inflation numbers, for instance, coming out of the States, a very large portion of that inflation comes from ultimately from fuel prices rising. And so when crude rises, fuel prices also rise, and that can percolate into a general rising inflationary environment. And so that tends to impact food commodities, some more than others. Okay, you need to really think about which countries are more exposed. You know, some food commodity exporting countries have those crops that they export representing a much higher percentage of their total GDP than other countries. So the amount of impact, obviously, that will be had really depends on, you know, how dependent a country's economy is oftentimes on a certain export product. Okay, so looking here at this next slide, this is crude versus wheat, WTI crude that is. Okay, very, very similar to what we saw in this previous slide with corn, but again, just note how the correlation is not consistently positive. You know, there are times where the other factors impacting wheat, such as climatic conditions, or perhaps there might be geopolitical events that are impacting crude but not impacting wheat, can cause this correlation to break down. Okay, so we did touch on safe haven markets. I'm going to just quickly try to go through this just in the interest of time. Here we're looking at gold versus the dollar-yen correlation, and so I mentioned before the yen, Japanese yen tends to be seen as a safe haven currency. I think most of us know that Japan has a debt to GDP ratio close to 200% or perhaps even above that. But I would say that with the majority of the Japan sovereign debt, Japanese government issued debt being held by Japanese investors or Japan domiciled investors, a lot of that that debt burden actually is being held in so-called safe hands, where there's a consensus that these investors in Japan will not dump the JGBs or other kinds of debt instruments linked to government debt, just because there's I guess a overwhelming sort of consensus that that without the debt being held or being sort of subjected to overseas foreign investors who might be less, you can say, loyal to holding onto that debt, there's a lesser risk of that debt being sold off in a violent manner. Okay, so just looking back at this correlation table though, at the bottom, what we see is that the correlation is negative for the entire 10-year plot. And so all that means is that the dollar yen tends to fall when gold rises. So when gold rises, it's often because of that flight to safe haven movement that we see going into gold, and because that happens quite oftentimes for the yen as well, with the dollar yen seeing the yen as the denominator currency within the pair, you get this negative correlation. Now the Swiss franc has a similar situation with gold, where there is an inverse correlation for the most part. Now the reason for that is the Swiss central bank for a very long time actually was backing the currency with a lot of gold. Okay, and for those many years leading up to 2000, I believe 2000 was roughly when that backing was removed, where the Central Bank of Switzerland decided it no longer needed to have a one-to-one, and I really don't know what the ratio of backing was, how much collateralization there was for the Swiss franc by gold, but the year that delinking should have happened was 2000, and so ever since then, it's really been backed by the credit that one would give to the central bank of Switzerland and to the Swiss government. And so basically, you can see that there was only one period in the correlation table in late 2013 to late 2014 where the correlation became positive. And of course, that was around the time of, if I remember correctly, and I might be wrong here, but it was close to the time of the Swiss National Bank basically changing its policy towards a peg that it had kept on the dollar Swiss franc and euro Swiss franc. Okay, so on the next couple of slides, which I'll go through quickly, I guess the point I just want to make here is the sterling or the British pound no longer has the same kind of impact it used to. So up until about 1993, the British pound was still quite influential in its impact on various commodities, which were historically throughout the British Empire and in the many decades since its fall, it was a currency that had impacted commodities which had previously been denominated in the British pound. So a lot of the soft and agri commodities, well, when I say agri, I don't want you to think about soybean, corn, and wheat, but if we just use agri as sort of a broad category to encompass soft commodities like coffee, cocoa, and sugar, there was a very large volume of these softs being the more accurate term in my opinion. There was a long period where these softs were traded predominantly in the British pound. Now, there still is the London cocoa market. So I used to work for LIFFE, LIFFE, London International Financial Futures Exchange, where I used to promote trading in the LIFFE London cocoa, which was denominated in the British pound. Now, there's also the ICE, or the former NIBOT, the New York cocoa, which has always been denominated in the US dollar. So the difference between the two really is the NIBOT, now the ICE cocoa, that New York cocoa denominated in US dollars, it is traded predominantly by hedge funds, whereas the cocoa in London, the former LIFFE London cocoa denominated in the British pound, tends to attract more natural producer or natural hedger, natural processor demand or supply on the futures trading. Okay, so it tends to be a more physical market, and so there still is some impact from the LIFFE London cocoa market onto the higher volume ICE New York cocoa US dollar denominated market. Okay, so I guess the bottom line is that British pound influence has waned over the years and continues to do so. And one thing to bear in mind is most of the cocoa processing that happens before cocoa becomes chocolate actually occurs in Europe, in Germany, and in the Netherlands. So there was actually a push by both the CME and ICE, and again, ICE is where I used to work, where the two exchanges decided at the same time, in the same month, I think, or at least in the same year, just a couple of years back, to launch a euro-denominated cocoa contract, just to take away that currency exposure that hedgers in the London cocoa market previously had to deal with. Okay, now looking at this next slide, we are looking at Arabica coffee and how it correlates with the British pound. So again, the influence from the British pound is much less than it used to be. The reason why there is still perhaps some positive correlation at times is because there is, just like with the cocoa markets that we were just talking about, with coffee, there is a Robusta coffee traded on the former LIFFE London exchange. Okay, so I used to promote the Robusta coffee, and Robusta coffee, just for those who might be interested, I'm sure most of you already know, it's a more bitter, higher acidic content coffee. It's generally used for the cheaper coffees out there. The more expensive cappuccino espressos tend to use Arabica. Starbucks claims that it uses Arabica for all of its purchasing needs. I have personally visited some of the physical coffee traders in various parts of the world, and well, they told me otherwise. But anyways, the reality is there still is some influence from the more physical hedger market in London on the New York, former NIBOT, now called ICE Arabica coffee market. Okay, so in the next, I guess maybe 10 minutes, I was just really quickly, I hope you guys are okay on time. I know we're going over, but I just really wanted to get through some technical analysis illustrations. For those of you who aren't familiar with my website, again, it's tradablepatterns.com. And every day I have 3 markets that I publish technical analysis on for paid subscribers. All clients of IB that received an email notification September 30th or October 1st, basically those of you who trade the markets that I write about, you would have gotten some kind of notification where you are entitled to a 2-month trial of my newsletter. And so within the newsletter, you get screenshots like this, where you get analysis within different time frame charts. So on the upper left quadrant, this one here is on ZW, which is wheat futures in the CME. We're basically looking at September 30th's analysis that I would have published for my subscribers that day. So on the weekly chart in the upper left quadrant, what we're looking at is a bit of a double bottom. And I basically, and I think I'll just try to take a spotlight, which I probably should have been doing earlier. This spotlight here is basically just going around what I felt were bottoming efforts of significance, which I labeled a double bottom here. But basically, we had a confluence of bullish events here. You can see on the weekly RSI stochastics that they were bottomish at this period in time on September 30th. And on the weekly MACD, MACD, you can see it was trying to positively cross. So pretty bullish from a sort of a generic analysis approach. But I try to compound what we see in this longer term weekly chart time frame with what we see in the daily chart and the 4-hour chart. So on the daily chart, what we're looking at really is a higher low here in roughly the week before I published this analysis. And you can see that I've drawn this green band. This green band really just illustrates the buy zone where I would be telling my readers I am looking in my personal account to go long. It's not a recommendation. It's just me creating a journal for myself and for people to hopefully learn my thought processes and techniques from. Okay, so you can basically see as well from the 4-hour chart, which I would consider a short-term time frame. You can see an ascending triangle is forming. So there were a few bullish signals from these 3 time frames, and generally when I see a bullish take away from each of these 3 major time frames, in my own account, I'll try to go long, assuming I have enough capital or enough risk appetite to do so. Okay, now if we go on to, let me just jump to this next slide. Oh, I think I need to get rid of, yeah, okay, here we go. Okay, so when we get to this next set of slides, we see the analysis from that same day for soybean, and I was basically writing bullishly. Now, obviously, soybean in this time frame, this weekly time frame chart, you can see it's still in a down channel. However, it was making what appeared to be a higher low, and more clearly seen on the daily chart. So on the daily chart, it was bumping up against the down channel resistance. It had been rejected a couple times, but it looked like it was getting ready to set up for a higher low. It did not look like it wanted to go much lower, below the September and August lows, or I should say the early September and the August lows. And so as a result, I had a pretty bullish bias here. And if you look at the 4-hour chart, you can arguably say a bullish flag was trying to resume. So the 4-hour chart perhaps doesn't illustrate a flag in its entirety or in a clearly drawn manner. But if you just extrapolate a little bit from the daily chart as well, you could see that, well, if we had a successful break in the days or week after this screenshot was taken, this daily chart screenshot was taken, you could extrapolate that perhaps that break higher would coincide with a break above this key 900 psychologically whole figure level. Okay, so that's so that's for soybeans. And my third idea that day was basically on raw sugar. So on raw sugar, you can see that we were looking on the weekly chart at a break above this descending wedge resistance. And this weekly chart at the time, and keeping in mind September 30th, that would have fallen on Friday. Okay, so this screenshot would have been basically the Thursday closing price action. Generally, I publish around midnight New York time. Okay, so this, when I see Friday noon, I'm within my analysis. I sometimes reference the Asia day. I'm based in Singapore, so if I say the Asia noon, that would be the New York midnight, just for those of you in the States. Okay, so on the rest of these time frame charts, you can also see that there was an increasingly bullish setup unfolding. So on the daily chart, we were still stuck within this down channel, but you could see that we had just made a very strong run up in the 2 weeks prior. And although raw sugar in the day or two prior to the screenshot being taken on that Friday, although those 2 days of Wednesday and Thursday were down days, I saw this as just being healthy profit taking, in light of the fact that the daily MACD was still very strongly sloping up. And if you look at the weekly momentum indicators, they were very much bottomish at the time. Okay, so of course you guys can check to see how these markets would have unfolded in the days or in the week after. Within my newsletter analysis, I actually also have a paragraph of analysis of text that accompanies each of these screenshots. So it's not just the screenshots that, as a subscriber, you get to see. Okay, so the day after, on October 1st, basically I had my, oh, you know what? I made a mistake. So on the prior day, September 30th, I just now would have said Friday. September 30th, I think that would have been, yeah, September 30th would have been the Monday. Okay, so October 1st is actually a Tuesday. So if you look at my analysis, I do have a fixed asset class that I'll provide guaranteed coverage each day of the week. So every Tuesday you get my indices day, where I choose 2 indices from my watch list. So on this particular October 1st, I had coverage on the NASDAQ 100 and S&P 500. And my third market that I covered that Tuesday could have been taken from any asset class. So I only have guaranteed coverage for the day's designated asset class for 2 markets. And the third market, which in this case is wheat for October 1st, which was the Tuesday, it can come from any asset class. Okay, so the third market is actually my top trading idea for the day. Okay, so I'm very aware that we're running over on time, guys. So I'm just going to skip through a few of these, just really to quickly highlight the approach I take, and you can go back into the archived version of this webinar later, and also you can go into my website. Even better, you can log into tradablepatterns.com and you can get the archived content if you're a paying subscriber, or you can go in through Interactive Brokers and you should be able to retrieve the archived content from September 30th or October 1st, depending on which time zone you're in. You should be able to retrieve all that archived content from the beginning of this 2-month trial period, okay, which doesn't end till the end of November. Okay, so I think you guys get a rough idea of my format of my analysis. Really, I'm really trying to have like a comprehensive coverage of different asset classes which I feel are interesting. So there's so on this particular day, October 3rd, I would have my FX or spot FX day, and on the 4th, which would be the Friday, I would have my softs day. Okay, so that's really the approach I take. And I guess what makes Tradable Patterns different is, I try to keep my analysis short and sweet. I don't like wasting people's time, and I really believe that in this day and age, with the rise of smartphones and with everyone distracted by so many different websites, so many different content providers, apps, and so forth, it's really important to keep the analysis to just the salient points, and that's really what I try to do. So I hope that's useful for you guys. This is the website. That's tradablepatterns.com, spelled TRADABLE patterns.com. And when you guys are at the website, you can really just click on any of the headlines to log in or register, or you can even from the right margin, you can see that there's this register login link. You can just click on that, and once you click on either of those, you can just follow the prompts. Okay, so if you've never registered before, I would recommend that you do. The advantage of having a free membership, which basically entitles you to one market's analysis each day, is you will get emailed, you'll get notified. Well, I used to do the email notification every day. Now I just do it once a week, really just so that as a free subscriber, you will be aware of when I publish. See, this content, this analysis is time sensitive, so it is very important for you to know when it publishes rather than you just randomly popping over to my website and checking to see if I've posted the analysis for the day. Okay, but it is roughly midnight New York time that I normally would publish on my website and through Interactive Brokers as well. Okay, so from the website, you can just preview how my free content would appear. Obviously, as an IB client, and I think most of you probably already have discovered my content, the free trial content available within Interactive Brokers, you will already probably be familiar with the format. Okay, so I'm really just speaking on for the benefit of everybody else who hasn't seen my content. Okay, so once you are logged in, registered and logged in with a free account, you can basically just click on the headline again of your choice. But if you are not a paying subscriber, you will not be able to see the archive content on my website. Free subscribers within the website will be able to see the content for the most current day. So let me just go here now to this next screenshot. This is for those of you who trade from your mobile through Interactive Brokers, you'll recognize this is basically a screenshot of how TWS, or I think it's just called IBKR Mobile, or I'm not quite sure what the brand is, but the mobile app of Interactive Brokers looks like what you see here. And within the news feed for this particular market symbol of SB being ICE's raw sugar futures, which in this particular screenshot I have a long position of, you can see that the news includes Tradable Patterns content. So it just runs down the page here. And this news actually is not of just raw sugar news, but of content that I would have contributed on other markets as well. So when you click on any one of those news headlines, it would basically pop open the free content. So just to illustrate, my reach has grown a bit since I started publishing on Interactive Brokers 5 years ago. So as of July, this past July, I had over 400 hedge funds, banks, mostly investment banks, asset managers, and corporates download my content off Bloomberg, Refinitiv, and FactSet in the month of July. Okay, so that's 400 plus firms. And this would include some of the biggest hedge funds in the world, as well as some notable investment banks that I'm sure you all recognize. And I was quite pleased to see, as of just this past mid-July, BlackRock's quant hedge fund unit known as Scientific Active Equity actually came on mid-July and has not stopped downloading my free content ever since they discovered it, I guess. So that's nice to see. When oh, hold on, why am I not able to get to this next slide? Okay, so when you're logged in to a Bloomberg, my content basically displays the same way any official news would. So if you do have access to a Bloomberg terminal, you can just type Tradable Patterns and all my content basically just pops up. And when you click on one of the headlines, it pops open a PDF, which is basically formatted more or less as it would display within Interactive Brokers. Okay, so this is a screenshot of Refinitiv Icons terminal. And if you click on the headlines again, a PDF pops up. And this is how FactSet terminals PDF content from my end looks. Again, same format. And just earlier in May, I think it was May or June, I started publishing technical analysis and fundamental analysis on crypto for Exmo, Eastern Europe's largest cryptocurrency exchange. So my weekly crypto content actually is on the top 3 coins, and you can freely, as a free website subscriber, you can view the content of 1 out of the 3 coins. And that would be, as you can see on this screenshot, that would actually include some fundamental analysis, not only on the blockchain in focus, but also on the industry as a whole, where I would talk about Libra or the PBOC coin or the JP Morgan coin, Walmart coin, whatever happens to be interesting for that upcoming week. Okay, so my content can also be seen on some other websites like Inside Futures. And if any of you have any questions, this webinar is going to be archived, so you can always tune in again. And of course, this is how you can reach me through all these social media accounts. But do feel free to WhatsApp or email me. It might be faster if you just WhatsApp me. And my website address is at the bottom here. So thank you all for being so patient. I do apologize for going over. Apologies for keeping you all from the rest of your day, but hopefully it's been enriching, and I do welcome some feedback. So if you do have any ideas on how this can be improved, or what I can maybe cover next time, do write me, and please do come by my website and let me know whether it's helpful or not. Thank you very much, guys. Thank you, Cynthia.
Well, Darren, before I do want to remind everyone, there's a questions panel. If you do have a quick question for Darren, go ahead and simply double-click that panel, and you can enter your question. But while you're doing that, I also want to grab the controls back for just a moment to show everyone how and where you can get Darren's research available through the Interactive Broker platform. Now, as Darren mentioned, we do have a promotional free trial period. For those of you who may want, if you've not yet signed up, you can access that information in our Trader Workstation, and as Darren showed you as well, it is available in our mobile apps. But notice here, if you go into the new window button from underneath the mosaic interface, you'll find that analyst research is available. And for the promotional period here, notice Tradable Patterns will get you access to Darren's research. Now, you can simply click this open. You'll see there is a group of articles now and the date that they have been presented. Double-clicking any of these articles can take you in, for example, into, let me see here, it opened up on my second machine, but notice that once you open it up, you'll see that that information will display directly here. Now, I did see several comments coming in about the charts are rather small. Well, notice here, once you do double click, you can actually go in and expand that section. But I also do want to mention, notice here, I'm going to go back, let me minimize this. We'll go back into Trader Workstation as well, because you can also utilize the news section here and create a filtered feed. Now, all I did was add an extra click that plus icon, went into the filtered feed, and you'll notice here that Darren's information is included in our Trader's Insight, but also notice that Tradable Patterns is available here as well. Now, notice if I do go in, I'm going to simply double click that section. Oh, and here let me see if that actually fell down behind here. Or, or it may have opened up. it does open up on a separate, well, this is what it looks like in our Trader Insight. Now, I did see several questions or comments that came in about the charts being very small, and I do want to pass along a handy tip. I happen to be a Windows user, and notice that by using my control key and the scroll wheel on our mouse, I'm actually able to increase by simply scrolling up, increase the size of each of those charts so that you can get in and get a better look. Now, I'm sure Mac users will have a similar feature where you can expand that platform as well. Now, also from the Interactive Broker website, what I am going to do is open up, well, let's open up a separate window. We'll go to my home screen here because you can find underneath the pricing menu, notice under research and news, we have a separate section that will show you all of the different additional features that can be added to your Interactive Broker platform. Now, notice here when we go into research news, you'll be able to find the information, either do a, what I'm going to do is you can do a Control F and actually locate tradable patterns. And from our website, you'll notice here, there is a free trial period. Right now, all of you have access to those newsletters. So if you are interested, simply go into Trader Workstation. Now, once the promotion is over, we still do offer a free one-time 30-day trial period if you want to try out the features from Tradable Patterns. Now, notice that free trial period is listed here. I'm going to also show you a Learn More button where you can get some additional information excuse me, as well as access to Darren's website. You can go in and view the products that are available. I do want to point out here that these reports have been integrated into the Trader Workstation. Now, with our recent release of IBKR Lite, notice that this will only be available through IBKR Pro that you can access through the Trader Workstation or our mobile applications. So I did want to show you that we've got quite a few different ways that you can access the platform. And excuse me, notice here as well, when I do go into Learn More, you can go in and visit that website. So plus, once that promotional period is over, you'll see that how to subscribe to Tradable Patterns. Okay, with that, I do see a couple of additional questions have come in. So Darren, if you want to handle some of those questions, I'll pass the controls back over to you. And if you would share your desktop, let's see if we can take some of these questions right now.
Sure. Yeah, let me just expand the window first.
Okay.
Yeah.
And now we're back on your slides. Thank you.
Yeah, let me just try to pull up the questions. Okay, I got it. Oops. Sorry, just bear with me. Okay, let me just enlarge this a bit. Okay, so I guess I'll just start from the beginning here. Okay, so, all right, so someone wanted me to talk about silver. It's been on quite a rally recently. Yeah, so with silver, I would say, you know, for the better part of the last, I guess it was couple of years, silver's ratio of the price ratio between gold and silver was at a historical high end of its range. So if you go back, say, 50 years or so, that range has been largely between 10 and 100. Okay, 100 being the price that gold would be as a sort of as a ratio against silver. So, for instance, if silver was trading at $10, then gold would be at 1,000. Okay, so it would be 100 times. Okay, so that ratio of 100 basically was an unusually high maximum within that historical range. But obviously, silver in the last couple of months, it actually has outperformed gold. So I'm not sure. I'm not sure which of you are actually trading silver and gold, but most people who trade silver would trade gold as well, or at least watch gold as well. So gold for a very long time actually had a lot of gold bulls. And I'm not going to name any names, but there are some prominent gold bulls out there who were advocating to just sticking to owning gold as opposed to silver. And this was ahead of the massive move up on both gold and silver. But the move up on silver as a percentage historically has always been greater during the bull market. So when there is a bull market in gold, typically silver eventually catches up. It's a laggard. So it takes a little longer to get warmed up generally to catch up to gold. But it eventually did, at least in terms of well, I wouldn't call it quite a parabolic move, but the way silver was running up recently, going into, say, a month back, was quite aggressive on the bullish side, more so than what we saw with gold, only because gold began its rally earlier. Okay, so gold also took its pause earlier, and both gold and silver are, at least in these last couple of weeks, consolidating. Silver specifically, I feel more bullish about, and I guess I have less of a conviction on the fundamentals around gold, just because I see just throughout a lot of recent history, gold's correlation to or at least its response to geopolitical events has been a little muted compared to what we've seen historically. So it hasn't really played the role of safe haven as well as it once has. And so I think silver has been a bit of a beneficiary as a result. A lot of people like silver, obviously because of its greater volatility, but also because it has industrial demand. Okay, so let's see. I guess there was a couple other questions around, let's see. Okay, about accessing the newsletter, which Cynthia has just addressed. Okay, and let's see. Okay, well, so somebody also asked about signing up for my website membership or subscription, but not receiving a password. So sometimes the passwords end up in the spam filter, and if it never gets, if it's not received within a spam or bulk folder, do send me an email at info@tradablepatterns.com. There are quite a few users who unfortunately did not receive the auto-generated email, the welcome email. So when that happens, just let me know. It's something that I'm aware of, and I've been working to get that fixed. Okay, so I guess somebody wanted to know my view on gold, which, well, I talked a little bit about just now. And I guess, let's see here. Yeah.
Well, Darren, what I would like to do, I'm going to grab the controls back from you for just a moment, because I also see there is another question here.
Okay.
Let me see. On TWS. So Bob was asking to repeat how to access this from our trading application. Notice underneath the new window button, if you go down to Analyst Research, you'll find all of those features that you have subscribed to, or that notice here is where you can locate the tradable patterns information. So simply click here and you'll be brought into, you'll see that separate window open. But I also do want to show you that in the news section of your Trader Workstation, you can add a separate filtered feed by going into that plus icon. Notice here I've gone ahead and added that filtered feed. And then you can also filter for tradable patterns information to display. So it's going to filter for those tradable patterns. Notice here you'll see the date of the release, and it does go back quite a distance here. So if you want to go back and take a look, and as you were just saying. You had mentioned silver and gold before. So notice when I go into or simply launch this, I'm going to go ahead and double click that. Let me see. I believe I've got a little bit of latency in the background here. But in order to filter, I'm going to go to that configuration branch and into the settings. You'll see it opens up a separate window here where I've got the general news. And notice there is a configure by subject. Now I've deselected everything except tradable patterns to give myself a window where I can go back and access any of that information right here. So did want to show you that that is available. All right, great, Bob, you've got that. Well, with that, I do want to thank Darren Chu of Tradable Patterns for a great presentation here today, and remind you that we have been recording today's session, and each of you will get a direct link not only to our recorded playback, but also to the same slides that Darren's been using for today's presentation. So if you do want to come back and review those concepts, simply watch your email later on today for that direct link. So with that, please join me in thanking Darren Chu for the time you spent with us. But I also want to thank each of you for the time that you've spent on today's webinar. So with that, you can all exit today's session using the X in the upper right-hand corner of your screen. And watch your email for a direct link later on today. Have a great rest of your day, everyone. And thanks very much to Tradable Patterns and Darren Chu for our presentation. Have a good one, all. Thank you.
Thanks, Cynthia. Bye now.